When it comes to the world of investing, only a few names pack more weight than Warren Buffett. Arguably the greatest investor of our time, his company Berkshire Hathaway is simply off the charts. Every year, the Oracle of Omaha shares a letter with his shareholders outlining the returns of Berkshire Hathaway stock since he assumed leadership in 1965. Would you believe he has averaged a 20.1% annual return from then until now? That figure gaps the market's average of 10.5%. Additionally, Berkshire's total return during this period sits at an astounding $3.6 million compared to the S&P 500's $30,000. All of these and many more are just some of the reasons why, when Mr. Buffett says something like this, you've got to listen.
Stocks are safe for the long run, and they're very unsafe for tomorrow.
So in this video, we'll be going through a thorough outline of some of Warren Buffett's ideas, tips, and valuable advice that directly apply to the economic situations that we are all set to face in 2024. But before we do that, we've got to understand the gravity of what awaits us. We have to consider the economic climate. According to Jim Masturzo, Chief Investment Officer at Research Affiliates, who oversees strategies for over $130 billion in mutual funds and ETFs, the U.S. is on the brink of transitioning from a decade of abundance to an extended and challenging period of austerity. Plus, let's not forget the fact that the rumors of an impending recession that have circulated for over a year are still showing no signs of slowing down or fading away. Despite the resilient economy and low unemployment rates, a recent Forbes column still anticipated a mild recession in late 2023 or 2024. Can you remember what happened in the years that followed the Great Financial Crisis? The average American got richer, right? While that is true, two amazing things happened. The first factor was a regime of exceptionally low interest rates orchestrated by the Fed. Initially implemented as a stimulus to safeguard the economy during the 2008-2009 financial crisis, the easy money approach resumed after a brief normalization period. Then, the Fed further cut rates to counter the impact of Trump's tariffs and significantly intensify these efforts during the pandemic. Between the beginning of 2010 and early 2022, the Fed funds rate remained above 1% for only 2.5 years, spending the remaining 10 years hovering near zero. The second factor contributing to the economic landscape is substantial federal spending. Already surpassing inflation from 2012 to 2019, federal spending surged during the COVID outbreak and its aftermath. It rose from $4.45 trillion in fiscal 2019 to $6.82 trillion in 2021. Marking a 53% increase, or nearly $2.4 trillion in just 2 years. Although expenditures have slightly decreased, they remain at a plateau significantly exceeding pre-pandemic levels. The budget for 2023, at $6.35 trillion, is merely 7% lower than the peak recorded 2 years prior. Over the past decade, these super low rates and high government spending ushered in bountiful abundance into the economy. But now that that's over, can you see why everyone is a bit worried? Sure, you can point out the fact that America's economy in 2023 provided a valuable lesson for forecasters. Despite initial predictions of sluggish growth, or even a recession due to the challenges of overcoming inflation, America surprised many by powering ahead with an annualized growth rate of approximately 2%, even as inflation subsided. But here's the thing. Recessions are more than just sluggish economic growth. They often bring along other distinctive features, including widespread job losses, a decrease in available jobs, and an increase in government relief measures, such as stimulus payments and enhanced unemployment benefits. These factors often make investors consider whether it's wiser to hoard every dollar they make in cash or if they should make future-proofed investments. In a recession, stock values frequently decline, theoretically posing challenges for existing portfolios. But what if we told you it's the best time to make money? Here's how Warren Buffett explains the bear market.
Anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of...
There are a lot of things to take home from Buffett's analysis. For long-term investors aiming to build wealth and who are under the age of around 55, A declining stock market is going to be advantageous because at that age, you are likely still a net buyer of stocks. However, on the flip side, if you're over the age of 70, chances are that you'll want the stock market to stay really high. At that age, you're more of a stock seller, so you'll definitely want the prices to always be high. That said, regardless of the category you fall under, you have to admit that most people have an emotional reaction to a receding market. While people tend to feel better buying stocks when the market is going up, we can't help but feel that's the wrong practice. The best time to buy stocks is actually during the bear market. Think of it as a sales discount. You're likely to get grumpy when you spot something you've always wanted at a higher price. But if there's a 50% discount, you'll probably want to take advantage of that opportunity. The same logic applies to stocks during a bear market. Don't be afraid to buy when prices are lower, as it's an opportunity to potentially benefit from discounted values. As a long-term investor, you should get excited whenever the stock market falls. Take a look at this amazing clip from Warren Buffett.
I thought the first 8 years, I thought the important thing was to predict what a stock would do and predict the stock market. And then I read Ben Graham, I was 19 or 20. And I realized that I was doing it exactly the wrong way.
Even when a recession happens, you should be following the lead of Warren Buffett and making future-oriented decisions. As he famously wrote in a 2008 op-ed for the New York Times, "Be fearful when others are greedy, and be greedy when others are fearful." This implies that when people are apprehensive about investing, particularly before or during a recession, you should seize the opportunity to acquire stocks and other assets at reduced prices. Additionally, Buffett also wrote that bad news is an investor's best friend. It lets you buy a slice of America's future at a marked-down price. This advice is still as relevant now as it was 15 years ago, during the height of the Great Recession. The only thing that you should avoid is attempting to predict the economy, and the stock market will rebound, as even experts like Buffett cannot accurately forecast such outcomes. As a matter of fact, he believes predicting stocks is the wrong practice.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all.
No, I mean, what are dumb things? Selling a stock?
Yeah, selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along the next day and says, "I'll pay you 15," you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks, but I think they're...
Moving on to the topic of inflation, Warren Buffett is also advising us all to invest smartly. Listen to this.
The best investment against inflation is to improve your own earning power, your own talents. Very few people maximize their talents. And the best investment, passive investment, I think, is a good business. If you own an interest in a good business, you're very likely to maintain purchasing power no matter what happens to the currency.
And then, there are a few key concepts here that are worth dissecting. Firstly, during periods of high inflation, the most beneficial action is to enhance your own earning power. You have to increase your value to your current or potential employers, enabling your income to rise in tandem with the inflation you experience. Additionally, Buffett suggests that the most effective passive strategy to counteract inflation is to identify a high-quality business and maintain your investment in it over time. Buffett threw more light on this in his 1981 shareholder letter. He specified that the businesses that are most effective in combating inflation possess two key characteristics. One is that they should have the ability to raise prices relatively effortlessly, even when product demand is stagnant and capacity is not fully utilized, without risking a substantial loss of market share or unit volume. The second characteristic he highlighted was the importance of a business being able to accommodate substantial increases in dollar volume, often driven more by inflation than genuine growth, with only minimal additional capital investment. What that means is that businesses do better during inflation when they are scalable. Consider, for instance, a technology firm like Instagram compared to an automobile manufacturer. For the former, The expense of displaying 3 ads instead of 2 is minimal. On the other hand, for General Motors or Toyota to boost production by 50%, they would need significant capital expenditures and a considerable amount of time to scale up. With that out of the way, let's go back to the crucial aspect of navigating inflation through investing, which is the first characteristic highlighted by Warren Buffett. You see, during inflation, the best companies to invest in are those that possess the ability to raise prices without sacrificing market share or unit volume. And guess what? This indicates that the company has a competitive edge or a moat that provides them pricing power. That's why Warren Buffett loves the Apple company so much. Just look at him wax lyrical all over it.
To be a better business than any we own. And we put a fair amount of money in it, but we haven't got more money in it than we've got in the railroad. And Apple is a better business. Our railroad is a very good business, but it's not remotely as good as Apple's business. Apple, has a position with consumers where they're paying, maybe they pay $1,500 or whatever it may be for a phone, and these same people pay $35,000 for having a second car. And if they had to give up a second car or give up their iPhone, they'd give up their second car. I mean, it's an extraordinary product. We don't have anything like that we own.
Say what you will about Apple, but one of its biggest strengths is its intrinsic value. When people buy an iPhone, they get sucked into the immersive ecosystem. Everything is linked. Apple TVs, MacBooks, iPads, and iPhones. It all works together. That keeps consumers happy and persuades them to continue with the product they've got. Plus, iPhones are kind of like a luxury product. To appear classy, most people keep buying newer, more expensive versions, even if they don't offer significant upgrades. In a nutshell, the significance of moats during inflation can't be overstated. These moats can take various forms, including patents, toll collection, powerful brands like Coca-Cola or Apple, and strategic advantages such as Costco's commitment to offering the best prices. These competitive advantages give companies pricing power, enabling them to set prices even when dealing with increased costs and reduced profits due to inflation. Businesses with strong moats are considered well-positioned to thrive during inflation, as they can adjust product prices to counter rising costs, and their competitive edges shield them from substantial declines in sales. Have you ever wondered why Warren Buffett loves investing in MasterCard stocks? It's due to the extensive economic advantage of the digital payments company. The vast network created by its 3.3 billion cards and numerous merchant partners establishes an extremely challenging network effect to duplicate. Plus, the company earns a small percentage from each transaction on its network. With its substantial scale, processing $8.2 trillion in gross dollar volume in 2022, these modest percentages quickly accumulate. In fact, they contributed to generating a free cash flow of $10.1 billion last year. MasterCard is one of those companies you need to invest in if you want to overcome inflation. Whenever prices increase, so will their slice of every transaction. And don't even get us started on the fact that trillions of transactions will eventually shift from cash to cards by 2050. The firm is completely future-proof. And this brings us to the concern of sky-high interest rates. Now that they're so high, how could we navigate the economic terrain in 2024? Here's an interesting take from Warren Buffett.
Interest rates, basically are to the value of assets what gravity is to matter, essentially. And
Honestly, that's truly the best way to view interest rates. When rates are low, money becomes cheap and easy for people and businesses to get. This leads to more spending, profits, and growth, which is what we've experienced in the last decade. Now, things are changing with interest rates going up. This means borrowing money becomes more expensive, making it tougher for businesses to repay debts, and people have less money to spend. So, this is a tough environment for businesses to operate and thrive in, which often shows in their financial results, which then affects their stock prices. Over the past 5 years, examining the trends reveals a clear relationship between interest rates and the stock market's performance. In 2018, as interest rates increased, the stock market remained relatively stagnant. The subsequent year, 2019, saw a decline in interest rates, coinciding with a rise in the stock market. When the COVID pandemic hit, the Federal Reserve responded by lowering interest rates to zero, resulting in a booming market for the following 2 years. However, a significant shift occurred in 2022, when interest rates experienced a substantial increase, leading to a 20% drop in the stock market. This pattern suggests a general trend. When interest rates rise, stocks tend to suffer. This decline can be attributed to two primary factors. Firstly, businesses may perform poorly, causing a decline in their stock values. Secondly, the impact of interest rates on government bonds, particularly U.S. Treasury bills or Treasury bonds, plays a crucial role. These bonds are typically regarded as risk-free returns, influencing investor behavior in response to changing interest rates. As investors in the stock market, it's crucial to maintain a long-term perspective. By doing so, we can leverage the lower stock prices of high-quality businesses as chances for lasting returns. Recognizing our limited influence over the Federal Reserve's actions, our strategy should involve playing the long game and seizing the opportunity to invest in excellent businesses at attractive prices, especially during periods of elevated interest rates. Nevertheless, what if we told you that even if you applied all of Warren Buffett's wisdom around tackling the big investing issues that we are all going to face in 2024, you would still struggle with your finances if you didn't check 3 boxes? To start with, you need to have plenty of emergency savings. If the dreaded recession turns out to be real, you'll need to have enough money in the bank to cover 3 to 6 months of living expenses, with the latter end of that range being more ideal. Build a solid emergency fund before you start investing. And this brings us to the second point. Don't touch your portfolio for at least 7 years. Make no mistake, guys, investing during a recession isn't for the faint of heart. While it might seem like you're making a smart purchase at a low point, there's a big possibility that you'll witness a decline in your portfolio value shortly after. The most effective strategy to minimize losses during a recession and ultimately emerge with gains is to adopt a long-term approach to investing, like Warren Buffett. And finally, reduce the urge to obsessively check your portfolio. In challenging economic times with heightened stock market volatility, you might feel tempted to monitor your portfolio daily, but don't fall for it. Frequent checking can lead to panic and rash decisions, like selling underperforming stocks hastily, which does more harm than good.